Welcome, welcome, welcome. We are here. Today has finally came, and I wanted to say thank you guys for tuning in and joining in. We are waiting on the underwriter, okay, and we wanted to discuss today the home buying process. And in today's time, it's turning into a refinance market. So we definitely want to talk about that as well. So I'm going to give you guys some time to come on in and thank you. Hi, Star. How you doing? I'm going to give you, hey, Monda. I'm going to give you guys some time to coming in, and we're having some technical difficulties here in the back. Let's see, here we go. Okay, there we go. So just bear with me, okay? And I'm gonna play you guys some music for a second as we wait on everybody to come on in. Okay. Okay, so tonight, happy Monday. I wanted to say first, I wanted to introduce my guests. And I want to introduce myself for those of you guys who does not know. You guys are lucky tonight because you got two people that's been in the business over 20 years. One being on the finance, well, both of us are on the finance side, and loan officer, and you have underwriter. And there are not many times that you get a chance to speak to an underwriter, and tonight is your night. So, whatever questions you have, uh, please feel free to ask. You can either ask your question in the chat or you could come up and backstage, just click on the link that's pinned in the chat and you can come up and ask your question and we'll be glad to answer. Um, but first, I want to ask you guys to do me a favor. If you guys could share the live, because we would like to get a little more anticipation. I'm going to give you guys a minute to share the live. Okay, we're going to go ahead and get started. So, let me just say this, okay? My name is Satonya Ford. I am a loan officer, loan mortgage broker. I have worked on almost every side of when it comes down to financing. I've worked for a bank. I've worked for a lender. I've worked for a servicing company. I've worked for a nonprofit. I have been a loan officer, mortgage consultant, um, mortgage broker, mortgage banker, mortgage counselor, you name it. Um, and I really do enjoy working and assisting people into getting into home ownership. I have known this lady that I am that's co-hosting with me tonight for over how many years, Lois? Okay. I've been knowing Lois ever since maybe 2006, and we've had a great working relationship, and we've been friends ever since. Um, we communicate. We've always stayed in touch, and we assisted each other. That's what we do in nowadays we help us one to another. And when it comes down to underwriting, I do want you guys to understand their position. Um, Remember, I tell you guys all the time that taking a loan application and the credit is what pre-approved you, right? It's the documentation that gets you to closing. Well, guess who got to look at the documentation, and guess who want to see the documentation in line with the guidelines in order to close the loan. And guess who signed off on the documentation? Yes, it would be the underwriter. She's here tonight. She can tell you guys what she's looking for when it comes down to documentation, why it's important to have everything the way that it needs to be. She's here to tell you the what and the why. Okay. And so I welcome her. And let me move some of this off the screen so you guys can see her. Okay. All right. Okay. I don't know if she's having some technical. Okay. I don't know if she's able to get on in to get her volume. Okay. She's trying to talk. Her volume is coming in. But okay, so while she's doing that, okay, I'm gonna go ahead and get started, and I'll be communicating with her through our private chat until she can get situated. Now, in this day and time, understand that market value is important. Um, Now, we're in a time where if a person can need to pay off debt and so forth, they can refinance. The reason why is because they have equity. What is equity? Equity is money in your house. That's why they call a house an investment. But before you could refinance, you have to finance first, right? So you have to finance the home, and there are some things, it's simple, but sometimes people hit a rock in the road, and we do understand that. And a lot of finance companies are prepared for that through their guidelines, because most finance companies they allow they look over medical debt that's on the credit report. They look over charge offs that's on the credit report, and then they allow collections up to a certain balance, right? So you don't have to pay everything off. Feel free to ask questions, okay? um, and you can drop them in the chat, or you can come uh, backstage while Lois is getting situated. And I'm gonna bring. I got a lady backstage, and I don't know if she have a question. Miss Gina, Miss Gina, is
Yes,
yes. Okay. Did you have a question about the home buying process, and so I can answer it? We're just giving Lois some time to get situated.
I'm in the process of buying my
Okay.
home,
Yes, ma'am.
and so a family member of mine sent me this link, and so I'm interested in learning how the process works because
Okay.
I'm not too familiar on how everything works. So
Okay.
for
Where
the
are
moment,
you?
I don't have a question.
Okay. So you've taken the application and you've had the credit report pulled, right?
Right,
So you've gotten pre-approved for a certain amount, right?
right.
Okay. So you're house shopping, right?
Well, I'm buying the home that I'm in.
Okay. Okay. And so you're interested in knowing, okay, so you've closed on the home, right?
Not yet,
Okay. So you're in the
since I've
process.
been sick. Right, I'm in the process of it.
Okay. So where are you? You've paid for the appraisal.
Um, the
I'm going,
as far as I know, the bank is handling all of this. That's why I said I'm
okay.
not. I don't know how the
Okay.
process works.
Okay. Okay. So let me tell you the steps. Okay. So you and then you can tell me where you are. Okay. So when you take the first step in taking a mortgage, applying for a loan is you take a loan application. Your credit is pulled from there, and they're gonna pre-approve you. See, it's the credit report that gets you pre-approved and get you and it's the documentation, it's the income that gets you qualified. Okay, so
Mhm,
whatever your income versus the debt that shows up on the credit report, okay, is what's gonna get you approved for a certain amount. Okay, so
mhm,
that means you'll be qualified for a certain amount, like let's say, for example, a $225,000 home. So because you got to stay within the ratio, more money can't be going out than staying in the home. Okay, and
mhm,
the loan officer is going to ask you for documentation before that file can go to underwriting. Okay, the documentation have to be submitted. They're going to ask you for driver's license and social security card, which is two forms of identification. They got to make sure that you are the right person that's applying for this mortgage and no one else is applying for a mortgage in your name. They are going to ask you for 1 month worth of income. They got to calculate your gross, not your net, but your gross. Okay. And then they're going to need ongoing pay stubs. They are going to need your last 2 years W-2s. You're going to need to have filed your taxes for the last 2 years. Okay. They are going to ask you for your W-2 again, or they may ask you for your tax return. I don't ask for tax returns. I just want the W-2s. Uh, 2 months of bank statements. That's 60 days of bank statements. That's what the guideline states if it's FHA. Okay.
mhm,
Okay. So um, then if you have like a 401k or assets, because you um I always look for compensating factors. So whatever I can submit, however I structure the loan to let the underwriter see how worthy you are for the money to get financing for the house, then I ask for your last quarter statement for the retirement. Then I package your file up. You're gonna always continue to send bank statement. You're gonna always uh, continue to send pay stubs. Okay,
Mhm.
until the loan close. You're at this point in time, once you provided documentation, okay? Once you provided that, then what happens is you're ready to go looking for a house. You find the house, you're shopping for the house, you and your realtor, and you're going to stay within the limit that they gave you, the pre approved amount. Once you find the home that that you like, and you're going to uh, have your realtor to write a contract and make an offer. Have you made an offer yet?
Mhm.
Okay.
Where I just have to pay
Appraisal,
my
home inspection.
um no closer cost.
Okay. So you found the house and you pay for the appraisal, right?
Yes, all of that is taken care of.
Okay. So you're just waiting on some money for your closing. There's a certain amount that you're gonna need. Did the contract state that you are going to have some that you did the contract have any money in there? Is the seller paying anything for you?
No, it was more of a it's a private uh buyer seller's contract,
Okay.
if you know what I mean.
No, I don't know what you mean. Is it for sale
It's
by
it
owner? It's for sale by owner?
right. I know the owner, so it's
Okay, yeah,
it's
it's for
like
sale by
a
owner. So that's what you mean
yeah
by private contract.
yeah.
Now, did you have any representation when you guys wrote up the contract?
As far as a realtor,
Mm-mm. Yeah. The reason why I
mm,
asked, I'm going to tell you this right here. Now, what I explained in the workshops and the people that's in the chat, they can tell you. I'm going to always let you know your perks so you can save money in your pocket. See, but
uh-huh,
there is a way that you probably could have been unclosed by now. If if you have a FHA loan, that program will allow the seller to pay up to 6% of your closing costs, whether your closing cost is 6% or not, because you shop for homeowners insurance. It can pay
mm,
your premium, and things of that nature. Okay. Now, on a
mhm,
FHA loan, of course, you do have a 3.5% down payment. It depends on your credit score. There is possible that there can be some down payment assistance available for you. And that way, you got the closing costs in the contract, you got the down payment assistance in the loan. So now you're free to just sign papers and not have to, you know, have any money for closing.
mhm.
Yes, ma'am. Miss Gina, I'm
Ma'am,
gonna
I'm
give
listening.
you I'm gonna give you my information. Okay. Here's
Please
my
do.
I'm gonna put my
Are you sending it to me in chat?
I I'm putting it in the chat now. I am
Okay, your
okay.
email address.
Yes. Feel free to email me tonight. Matter of fact, email me right now if you can.
Okay.
And send me your phone number because I'm gonna review some things and show you where you are. And I got a few questions let me just go over this part with everybody, and then you'll see, without me asking you that question publicly, you'll know where you are.
Mhm.
Okay, with this, you'll see if you
Okay.
fit. So now I want to talk to you guys about down payment assistance. Okay, down payment assistance. There's different forms of it. Okay, some lenders have it available for you to attach to the loan. It is called a second lien. Well, why is it called a second lien, Satonya? It's called a second lien because you do have to pay it back in some cases. There is two different types that some of the lenders have
Miss
available for
Ford.
you. Yes. Oh, I can hear you. Hey,
Oh,
Lois.
goodness. All right. That was
Was it a
something
struggle?
else. It was this
Okay.
these devices, I tell you. But just go ahead.
Okay.
Okay.
Well, it is so refreshing to hear your voice. And while I'm gonna give you the floor in a minute, to elaborate on some of those things, while I give some people a friendly reminder, you know.
All right,
Uh,
sure.
but I want to talk about the down payment assistance. There is one down payment assistance that's available. It's called Forgivable. Forgivable down payment assistance, it can go up to 5%. Okay. That means that on an FHA loan, let's say that you only have to put 3.5% down. Well, the forgivable can go up to 5%, which means that it'll cover the whole amount of the down payment, and then it'll pay on some of your closing costs. Okay. But they do charge a fee, but the fee comes out of that 5%. So it's subtracted from it. You don't have to pay it back because it is forgivable, right? That means you don't have to pay it back. But with a 5% down payment assistance, it may come with some rules like you can't sell your house for so long, you know, things like that. Now, with the down payment assistance that is repayable, the other perk is the lender will pay some of your closing costs for you as far as your origination fee. Now, then that means it'll go up to 5%. The credit score has to be 640. And then, but you do have to pay it back over a course of time. Okay. So let's say that there's no money in the closing costs, I mean, in the contract. Okay. So if there's no money in the contract, and you're squeezing, okay? So if you can go with a program that the lender will pay some of your origination fee for you, and then the down payment assistance is going to pay the down payment uh, for you, and then so it rolls over and pays some of your closing costs. So we're crunching numbers here. We're trying to save money in your pocket to where it benefits you to be able to have a smooth closing, and not only that, you have a smooth closing, and then you get a chance to go ahead and move in your house and save some money and have the money to, you know, buy you a new broom, new mop, a lawnmower, weed eater, blower, da 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 da. Okay, so that's what I have for that. So we got Lois. She's here, and let me just say this: Lois has been one of the best underwriters I've ever worked with since I've been in the industry. Okay. I just got to say that there are very few that you really enjoy working with. And when you find one of them that you can work with them real good and they know what they're doing and they don't need your help to understand nothing, then you got yourself something. So that's what I want to say to you. You guys, I'm gonna tell you, feel free to ask Lois any questions. She'll help you. She'll help you understand. She'll break it down to you. Come up if you need to come up, and feel free to ask her any questions that no such thing as a crazy question, stupid question, dumb question, just whatever. You got two people here that is got the answer to whatever the question is that you've been wanting to know that nobody can answer. Miss Gina, did you want to come back up? Let me see and talk to the underwriter. Miss Gina.
I'm
I'm a,
here. I'm back.
okay. I'm gonna let Lois introduce herself, and I'm gonna bring you back up so you can, uh, we're gonna share some more things, and then I'm sure you may, if you have a question, feel free to ask. Okay.
Okay.
Okay. Okay. Okay, Lois, you got the floor, girl.
Oh, well, good evening, everyone. I'm so sorry to be late. But as Miss Ford said, and all that she has said, I can reciprocate that she has been awesome to work with. If you need something done, she's not afraid of whatever your scenario is, and we'll figure out a way to get it done for you. So kudos to her for that and for enduring in this industry that we've been a part of for so long. But I'm just here to help because we, this is an area having to deal with finance, specifically real estate finance, where often, we fall through the cracks. Speaking about mainly people of color, even people who just aren't aware. I've dealt with different types of people over the years, from very wealthy to not wealthy and everything in between. And nobody really understands mortgage. So you shouldn't feel that you've lost out on anything. We're here to help to get you to understand. And if you want to become a homeowner, if you need to refinance, or if you're just curious and you've never been able to ask questions, ask away. That's what we're here for. So I've been in the industry for more than 20 years, underwriting about that length of time. And, I'm just willing to talk to people. The last situation, Miss Gina, I was wondering if you were in a lease option, and that's what I was trying to type in the chat, but it wasn't working. I was wondering if you were in a lease option or if
I
you have
was.
some other contract that was going on. Um, because the main thing with a private mortgage is you have to keep in mind at some point you might actually want to refinance and come out of the private financing, and you have to track your payments somehow. There has to be a paper trail that's consistent. And that's been the challenge whenever there is a private mortgage or it's not recorded properly. So, those are a couple of things that you want to look into whenever you speak to Miss Ford offline. She can talk to you about that
Gina.
Okay.
Okay.
because you don't want to be in a position where you've invested in a home and put all your love and care into it, and then not have your home at the end of the day because you chose to do private financing without the proper paperwork in place. And they usually know that it's not proper. So you have to be careful. Even if you know someone, even if it's family, doesn't matter. That's business. So you have to be careful and ensure that you're protecting yourself.
So check to see if I'm able to refinance later with the loan.
Absolutely, because you don't want to
Okay.
stay in a private mortgage situation. You want to ensure that they have transferred the title to you, the deed to you, that it's properly recorded, that there are no penalties for early payment, and that you are keeping track of your payments because they may not be. With a private mortgage, we usually ask for like canceled checks or something to show that your mortgage is being paid timely. So that's something you would have to do. I know that Zelle and Venmo and all those things are popular, but you never know. So I would ensure that I'm tracking my payments. Mhm.
And
So
Miss.
what if
Go
I
ahead.
was to have it set up to where it's automatic taken out of my account from the bank?
Well, if it's auto drafts, we could do 12 months bank statements. Just make sure it's consistent.
Okay, all right.
Hmm.
Okay. So Miss Gina, did any of that did you did they even did you um have interest in that down payment assistance program that I was talking about?
Yes. Especially the
Forgivable.
forgivable.
Of
But
course.
if I'm not mistaken, um, I qualify for the down payment assistance program.
Now there's different kinds of them, okay? There's state
Okay.
based, okay? And there are some that the lender have available,
Okay.
okay? Yeah. Okay.
But
Did you
how
have
can
any?
I
Go ahead.
do this forgivable?
Well, first you have to take a well, you got to qualify for it. And that's why I said email me. And have you emailed me already?
I did.
Okay, hold on. Okay, I got. I think I got your yes. Okay, you email me, but email me your phone number.
Okay.
Okay, yes, and I'll be glad to, and I'll email you something. You know. So, does anybody have any questions in the chat? I know I've had a few people tell me they were on. But go ahead, Miss Gina, and I can bring your question up if you didn't want to click on the link. Remember, you can click on the link that's pinned in the chat, and you can come up and ask your question. Go ahead. Okay. All right. So, Lois, I have a question for some people. Okay.
Sure.
Okay. The question is, okay. Yes. The question is, um, if a person has been receiving Social Security, okay, and oh, she dropped down. Hold on. Okay, Lois, I'm waiting on Lois to come on back, y'all. But does anybody have any questions? Remember, there is interest rates are going down. Okay, so if you got pre-approved some time ago, you may qualify for more now because an interest rate determines your payment. So rates were 7 and 8 a couple of months ago, okay, and last year, okay. So now rates are like 5%. So let's say that you couldn't find the house that you wanted because you couldn't find anything in that price range. Well, now it's time to kind of take a second look to see what you can qualify for now because you could qualify for more. And I understand sometimes when you're in a certain price range, you can't find what you're looking for. Maybe you're trying to look for a certain school district. Maybe you're trying to look for, you know, but you want to make sure that, okay, y'all, here come Lois. Okay.
Sorry about that. I don't know what
It's
I
okay.
touched, but I heard you say,
It's sensitive.
oh my goodness. I heard you say if someone's on Social Security, and
Right.
that's it.
Thank you.
Okay. Hmm.
O Okay, so perhaps someone was on Social Security like, for years, and then they decided to go get a job, and
Hmm.
the Social Security discontinued. And, um, 3 months, they've been working for 3 months, and the Social Security, was discontinued 3 months ago.
Hmm.
What would that person need to do? Or how would you guys, as an underwriter, view that, and what is the guideline?
Okay. So Social Security has been their only source of income, correct?
Yes.
All right, for a period of time, for
Uh-huh.
some time. All right. Well, then we look at 2 years of employment history
Mhm.
is what we look at. So if you had a significant gap in employment, meaning no income coming from a job of 6 months or greater, then we need to look at the previous 2 years
Mhm.
where you actually did have a job that we can document. And that's going to vary for each person. So, and then they would have to be on their current job for 6 months.
Okay. Okay. So they would need to be on the job at least 6 months after the Social Security discontinued. Is that what you're
Cor-
saying?
Correct. They
Okay.
would need to be on the job at least 6 months. And then
Okay.
we would need to document
Okay.
that they were employed for
Okay.
2 years consistently at some point.
I need to take notes, y'all, because I've had several calls in reference to that. Matter of fact, I'm gonna text the realtor. Okay.
Yeah,
And
because that's actually happening with a lot of people now. They're having to come from being on disability, Social Security, retirement, and entering back into the workforce because of the economy. So it is something that's happening a lot now.
okay.
Hmm.
Uh, also, um, Miss Petronia had a question. She says, once you refinance, are you paying two times for interest? Okay, let me tell you, I can answer that. No. Let me say this. Interest rates are going down. Okay. So, Lois, um, I just locked somebody in at a 5%.
Nice.
Yeah. Yeah.
Hmm.
Um, a couple of months ago, were they what, 8%?
Hmm.
Uh, you know, so that's three numbers down.
Hmm.
And can you elaborate for them what how an interest rate determines their payment? You know, how, the I did tell them that the interest rate determines their payment, but can you break it down for them a little bit more, Lois?
Can you not hear me?
I can hear you now.
Okay. Basically, whenever you have an interest rate, it affects the principal and interest portion of a mortgage. So the higher your rate, the higher your payment. What had been happening is since homes are, I mean, rates really, if you know anything about real estate, you know that rates really didn't get that high because I know Miss Ford can attest to years ago when we joined the industry, you had excellent credit and a large down payment, and you still were getting 6 and 7%. But since housing prices have come up so significantly since then, um, you had to have a rate of 3%, 4%, 2% in order to qualify because of the home values. So it makes a difference. Your interest rate makes a difference in whether you qualify or not at times because the higher your rate, the higher your debt to income ratio. So it can be a difference of several $100s to the point where you can or cannot qualify. So if you can get locked in at 5%, it's a good idea to do that because we had been last year in the 6 to 7% range, and that was for very good credit, still 6 and 7%.
Okay. And the next question is, so if I financed $100,000, interest is okay, and then it says 20,000. Is that erased and you start with new interest? Okay, so are you saying that you put $20,000 down on $100,000 house because the 20,000, if you're asking putting $20,000 down, that doesn't that's putting it down. The loan starts with the I'm gonna break it down like this: 100,000 with a down payment of 20,000, so it'll be 80,000 of the money that will be financed. Okay, so help me get an understanding of your question, or feel free to click on the link so we can get an understanding of what your question is. Lois, do you understand what she's
I
asking?
think she might be asking about buying down the rate
Okay.
because you know how they don't really explain that often to people. So they don't know when they're putting 20,000 down what that 20,000 is going toward.
Hmm.
Was it going toward the cost of the home or was it going toward buying better terms for the loan? So when she's saying paying twice, she might be talking about that. She might be talking about a rate buy down.
Okay, she just posted something else. If that's a example of what was added in the loan on the $20,000 loan.
A $20,000 down payment or $20,000 loan?
Well, she's saying added link a top at top. Okay. It's she's saying it's that's a example of what was added in the loan on $100,000.
That 20,000 was added to it.
We want your question answered. Okay. Um. Okay. I'm trying to get an understanding of the question because it sounded like it was a down payment at first, but she's saying it was added on the loan. Now, on $100,000 loan, let's homeowners insurance and okay, here we go. Here she go. Let me bring her up. Hey, Petronia, can you hear? Let me unmute you. Uh, can you hear? Okay, let me see. Uh-oh. Sh- Her 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 volume is not working. Okay. Try to go down and come back up and use your audio. Okay. Now, where are you, Lois? Lois, are you there?
Yeah, I'm here.
Okay. Okay. All right. So her audio wasn't working. But
I think she's talking about refinancing. She said if she financed 100,000, the interest is 20,000. I don't. That sounds like a lot.
mm,
Is
mm,
that erased and you start with new interest? So if you've
oh,
paid 20,000 already, do you start with new interest? Basically, mortgage loans are simple interest loans. So where a higher balance comes into play has to do with your closing costs.
here she go.
So for refinance,
Petronia, her audio still not working.
mhm.
Can you chat type in the box whether she thinks she know what you're asking and she was elaborating on it? Can you repeat that, Lois?
It sounds like she's asking if she has to pay interest on a loan more than once. So if she has $100,000 mortgage, and if she's paid 20,000 over the years and it's gone down to 80, you're not going to, if you refinance, you're going to pay closing costs, and then you only pay based on whatever your new loan amount is. So you're not paying interest over and over and over again. If there's a refinance involved, you're either going to refinance in order to lower your rate, to um, extend the term of your mortgage, to pay off debt. There needs to be some sort of benefit to that. But you're not paying interest. It's not like student loans, like where you have a student loan and the entire balance with the interest is then rolled into a new loan. Mortgages don't work that way. So you're going to start with the balance that is left after you've made 20,000 in payments. Whatever that balance is, that's what's going to go toward the new loan. Plus, you'll have closing costs, so you'll have, whatever debt you've paid off and so forth. But it's not a situation where you're just constantly paying interest where you can never pay off your home.
Okay, she said that was her question. That
Hmm.
was. So I also want you guys, for those of you guys that does not know, Lois, can you elaborate on your position as an underwriter? What all needs to take place once the file gets to you,
Hmm.
and what you're looking for within the file.
Okay. Well, basically, once you speak to a loan officer like Miss Ford, she would submit a package to the lender, and I would receive the package. Package would include a credit report. It would include income documents, whether you're a wage earner, self-employed, retired. It would include whatever income documents would go along with your situation. It would include bank statements to show what you have in assets and what could go toward the loan for down payment, or to reflect how financially stable you are. It would include at some point an appraisal, and anything else that's needed in order to support the story that she's presenting to the lender. So basically, I usually start with reviewing credit report and application. That tells me everything about the transaction I need to know, basically. And then the supporting documents are the income and the assets, and then eventually the collateral, the appraisal. So basically, what I'm looking for consistency in your story. So I'm looking for 2 years of employment history. I'm looking for 2 months, sometimes three, of bank statements. I'm looking for 2 years of residence history. Where have you lived for the past 2 years? Have you been renting? Do you currently have a mortgage already? Have you ever owned a home? Um, I'm looking at your complete financial picture and credit to determine if you have the ability to be able to repay the loan for whatever home you're looking at or whatever home you currently own. So from there, basically, it's just a matter of verification after that. Once it makes sense, then I start a process of verifying everything that you've submitted.
So that means that, so tell me this, okay? Because I've ran across some people that seem to think that, um, the 4506 form,
Mm-hmm.
right?
Mm-hmm. Mm-hmm.
This is what I always tell my clients. I always talk to them about filing their taxes before they take that loan application for the last 2 years, because that 4506 form, most of the time, people want me to have the address properly, um, under it need to be understood where what address they use to file taxes, because that form will
Mm-hmm.
kick back.
Absolutely.
Okay. So when it comes down to that 4506, because this is a form, you guys, that we have to use, behind the scene to verify that you file taxes. Which loans cover this 4506? Is it, it's just FHA? Is it conventional, or is it all?
It's basically all,
Okay.
because um, even it used to be that it was just something that we wanted for self-employed persons
Mhm.
because we had a tax return in file. We want to be able to validate the return. Otherwise, we're doing a stated income loan. So it used to be that it was just for the self-employed borrower. However, since we're so savvy now with
Mhm.
income documents,
Mhm.
it doesn't matter what product, it doesn't matter what the employment or income source is, we still need to validate the income. So if, as the lender, if we're not doing it, then the investor will execute the 4506 in order to validate what is being reported to the IRS.
Okay, so when you say the investor,
Mm-hmm.
that's something I would like to go into with them, just a little bit just briefly, okay?
Mm-hmm.
So I always want tell them to that, you know, more when some mortgage companies are what you call servicing companies, okay? That means that you'll make the payment to them.
Mm-hmm.
But some mortgage companies, when you close, they're going to package your file up just like we packaged it up when we did everything. We got the documents, we got the appraisal, everything. We closed the file, right? So they got to package the file up to sell the loan, and everything is going to stay the same except who they make payments to. So when that person buy, when the servicing company buy the loan, right? They're going to do some audits, right?
Correct. There will
O-
be audits done. There
Okay.
will be a validation process that gets done. At times, they will come back to us and ask questions. At times, they will request additional documents.
Even
It,
after the loan is closed
even
out.
after the loan has closed. And at closing, most lenders require that you sign something saying that if any additional documents are needed, that you will provide them. And we have had situations where people say, "Hey, I got my keys." But there is a process that we can go through where we can actually recall the note and take away those keys, because it's not the end of the story. It is a 30-year loan. And so once you close, it's great. But if something comes back where, when we're validating what you've told us, um, it's just not accurate, or if something happens where you don't make your first mortgage payment and you default, then there are steps that are taken after that. So it's just good to be honest. It's good to actually be committed to the loan, um, and the mortgage, be committed to the home. If you're not, then just don't waste your time.
Right.
Don't waste your time, because that's not the end of the story. And I know we've seen all these cases of like mortgage fraud, and oh, well, they got away with it. They really don't.
Right.
They
And
don't get
that's
away
what
with
I
it.
wanted
Hmm.
you to I needed that's the part,
Hmm.
because I I'm across the board, and I know that there are people that does a lot of things. But when that loan if that loan is sold and they don't like that loan once it's audited, they can send that file back to the sender.
Right. It's a repurchase process that we have to go through, where we have to assume, we have to give them basically their money back. And
Mhm.
then to recoup the money that we had to
Lost.
return, right? Then
Mhm.
we recall the note.
Okay, so I did want people to know about that process, because that process right there is not talked about. And, a lot of times people, like, once they close, they think, that that's it, and that's not it. You know, it's just not talked about enough. And I wanted them to hear it from the words of an underwriter. I have someone to bring back up. Hold on one second. Hey, Miss Gina.
Yes.
Okay, we can hear you. You have a
What was I
question?
supposed to say? Oh, I put them in chat, but
Okay.
I wanted to know, since the interest has gone down this year,
Mm,
will it affect my score if I was to see
mm.
if I
Interest.
qualify for more?
Okay, interest rates doesn't affect your score, right? So your
Okay.
score is what attracts the interest rate. It Did I say that right, Lois?
She's asking if she checks to see if she qualifies for more, if that will have an effect on her credit score. So a credit inquiry will have a small effect, maybe a point or two, but not that much. You should always, make sure that you're getting the best possible
Deal.
rate and terms for you. You should always make sure of that. I wouldn't go and have my credit checked 20 times, but if you deal with a broker, then they'll be able to check rates from several sources.
So well, whoever I'm financing with, I mean, will I be able to just go to them and say, "Hey, I see the interest went down. I mean,
Well, they should
If
however,
have.
it's a
like the
private
percentage.
mortgage, if it's a private mortgage, probably not. They probably have their rate that they charge because it's
Okay.
kind of an alternative way of getting a mortgage. If you want a lower rate, then you would have to deal with someone like Miss Ford who can possibly get a lower rate for you. Private financing is very different. The rates are typically higher. I've never seen private financing where the rate was lower
Okay.
because they're not going through a qualification process.
Okay.
Mm-hmm.
Also, what's the difference between a down payment and a closing cost, and how does that work towards the mortgage loan?
Mm, okay. So down payment is okay. Let's say that you're buying. I'm gonna throw an easy number out there, right? $100,000 home. Okay.
Uh
So
huh.
if it's an FHA loan, okay, the down payment on $100,000 is would be 3.5% of whatever that sales price is. So if the sales price is 100,000, then 3.5% of that would be 3,500. So that will be your down payment. So there are many people involved in your mortgage transaction. There's a title company, then you have to get homeowners insurance, right? There's the
Mhm.
mortgage company, then there are third parties like appraiser, okay? You may get a home inspection. Those are what you call fees, right? So everybody is doing a service for that because the title company got to make sure that the title is clear. So they have to do what you call a title search and make sure that the hands is just like, like with a car, the title needs to be a clear title in order for them to
Mhm.
sell it. Okay, the title needs to be a clear title for them to sell the property and it transfer from one hands to another. So they got to do that due diligence. Okay, the mortgage company, we have to process the loan. Um, there may be a processing fee, underwriting fee, whatever the case may be. Okay, and then an origination fee, right? So in some cases, the way I'm set up, the lender could pay it for you, and sometimes it depends on how the loan is structured, then you will pay it. Okay. Now, a lot of cases, if it's a conventional loan, the seller can pay up to 3% of that 100,000, right? So if it's a conventional loan, then you can get pre-approved for either 97% or 95%, which means that you would pay the difference to make that full loan a 100%. So on the FHA, going back, and I don't mean to confuse you, the loan they will lend the money that they will lend you will be 96,500. So you take 96,500 and then plus your down payment, which is 3,500. Both of those two numbers will equal to $100,000, which is your sales price, right? Okay, so if it was a conventional loan, then either you can get pre-approved for 97% or 95%. So 97% means you have to put down 3%. 95% means you have to put down 5%. But on a conventional loan, the seller can only pay 3% towards your closing costs. But on a FHA loan, the seller can pay up to 6% of your closing costs, whether your closing cost is 6% or not. It can be applied toward homeowners insurance premium, your real estate taxes, and stuff like that, your escrows. Now, 6% of 100,000 will be up to $6,000. So if that's negotiated with the seller and they come to an agreement with you that they will pay 6% towards your closing, then that's less money that you have to come out of your pocket with. Hello?
I'm listening.
Okay. So that's financing. Okay.
Mhm.
So that means the lender will loan you the majority of the loan, and then you got a small portion because they want you to put something in it. It's an investment. They want to, you know, put a small portion in it to make it a full 100% loan.
Okay.
Okay. Now,
Mhm.
remember now, if there's down payment assistance involved, it can put the down payment assistance down for you. And then if you got 6% in the contract and then you got money in the down payment, then you'll come to the closing table signing papers.
Okay.
Does anybody have any questions in the chat? Okay, I'm trying to. Okay. Oh, and please like, comment, and subscribe to the channel. Thank you. Miss Gina, um,
Yes.
you said you found the house. You guys wrote the contract and everything.
Yes.
Okay. Okay. So if is the seller a family member or a friend?
Family.
Family. Okay. Do you guys have the same last name?
No.
Okay. Okay. All right. I'll talk to you. But yes, now let me talk to you guys about home warranty versus homeowners insurance. So, in the process, in flood insurance, in the process of you guys looking for a property, right? So there are what you call flood zones. If you find a property that is in a flood zone, no matter how much you like it, just remember that not only are you going to have to pay at closing a year up for homeowners insurance, you're going to have to also pay flood insurance. So there's two different things because homeowners insurance does not cover flood. But if you're in a flood zone, then it's mandatory that you get flood insurance as well. Okay. So also, when you're getting ready to purchase a home, I always tell the buyers because remember, y'all like to throw out first time home buyers. So if you're a first time home buyer, then you don't know this, right? So I always tell you guys to make sure that the seller is going to pay a home warranty up for a year. And they will do that sometimes. It's I see it 9 times out of 10. Okay. It's almost standard that they do it, but sometimes they don't, sometimes they do. It depends on what the contract is looking like. The home warranty, you have um it's almost like homeowners insurance, right? The home warranty normally cover the refrigerator, the stove, the washer, dryer, hot water tank, right? Okay, those are the basics. Now, when your paperwork after you close and the paperwork come in the mail, you would need to get in your own business. That means you need to call the home warranty company and find out what all does this home warranty cover. If it does not cover the roof, central heating, air, and other things, pipes, electricity, then ask for an add-on. I'm gonna tell you why. Because here's the situation a lot of people are giving me a call about. Sometimes when there's natural disasters like tornadoes and hurricanes, your insurance will go up just because. Okay? So because your homeowner's insurance has increased, now your payment has increased because you pay your homeowner's insurance inside the mortgage payment. It's what they call escrow. That's a whole nother department that holds on to your homeowner's insurance and your real estate taxes until they are due to be paid, and they collect this money in this department so your homeowner's insurance can be paid on time and your real estate taxes can be paid on time. Okay, to make sure that it gets done and you're covered because they want to make sure that their financing is secured. So If by chance you pick up the phone, let's say you got homeowners insurance and you got $1,000 deductible versus the home warranty. And let's say your hot water tank went out on you. Well, let's say the hot water tank may cost $600, $700. Well, there's no need to call the homeowner's insurance company tell them that you're having hot water tank problems because you got a $1,000 deductible. It's not going to cover it anyway. Okay. This is when you call the home warranty company because all they're going to do is charge you a service fee for someone and send someone out there so they can check the hot water tank. And if it's fixable, they are going to fix it. And if it's not fixable, they are going to replace it. So if you only have the basics, then if I were you, I would do an add-on and make sure it covered the central heat and air, this, that, and the other. Because once you pick up the phone and call that homeowner's insurance company, then you just as well filed a claim. And by the time your bill is due, your premium is gonna go up. Anybody have any questions?
I do.
Yes, come on.
I was told that sometimes, depending on how old the house is, would determine if
With the
they
insurance
will
premium.
cover the warranty, the home warranty would determine if they will cover everything.
Okay, Lois, can you help us with that?
Well, well, when you purchase a home and it's a brand new home, it comes with what, 1 year construction, like structural, and then whatever else is covered. Like if you have Whirlpool, um, um, if you have Whirlpool, refrigerator and stove and all of that, there's a separate warranty for that. But there are different levels that are connected to your warranty for a new home. If you purchase a home and it's not new, then they understand it's not new. So how you're insured is going to be different. So that, what is it, 210 warranty or whatever it is that you get for new construction for that, it's different from if you purchase a home that has some age on it, but it still has coverage. There's still coverage available. Um, it's just not the same kind of coverage because it wouldn't be necessarily structural if the house is already settled and it's, has some age on it, some years on it. So it's almost two different products. I would always, like, whatever your situation is, somebody will sell you a home warranty.
Mhm.
Somebody will,
Mhm.
because that's the business that they're in. But there are basically two different products because I know with that, like if it's a builder and it's a new build, then they do offer a warranty that they cover, that they pay for. And then, well, most of them. And then if you are purchasing a home outside of that, outside of new construction, you have to find your own warranty. But most definitely, someone will sell you one. I'm not sure, you have to check and see how good the product is, but they will sell you one. And I'll add to that if you don't have homeowners insurance, because I'm finding that a lot of people don't for whatever reason, whether the insurance company they use no longer insures with them because of natural disasters, you do have the option to contact SBA for natural disaster assistance when you don't have homeowner insurance.
Well, what I understand is I've ran across a few people that insurance lapse. They
Hmm.
put insurance that cover it covers them, but it doesn't cover
Yeah,
the
that force placed
the
insurance.
foremost. Mm-hmm.
Correct. Hmm.
Mm-hmm.
So then, if you want to help with, if you need help with contents, if you need help with structural damage, then you contact the SBA for that disaster if it was truly a natural disaster.
Mm-hmm.
And that's a Small Business Administration. I don't know if that's it.
So, did that answer your question, Miss Gina? Oh, and also w-
Yes.
when a property is 10 years old or less, then the insurance normally be a little more reasonable.
My property
If
is
the
this way more.
that's why it's important to always let the insurance company know. Like if you find a house that's that was built 5 years ago or 10 years ago, I always 15 years ago, I always ask the realtor um how have the roof, how old is the roof, or how old is the central heat and air, because that's the information that you need to give your insurance agent. Because if the roof is less than 10 years old and the air conditioning unit is less than 10 years old, you get a more reasonable premium.
You said the roof and the
Central heat and air.
AC.
Mm-hmm. Mm-hmm. Does anybody have any questions? So, okay, we were talking about buying a home. So let's say now that you've closed, you said you was a first time home buyer, right? So an appraisal is good for 6 months. There's a reason why it's good for 6 months. The reason why is because market values fluctuate, sales in the area. Let's say that there's a whole subdivision that's being built. Okay. So the first house is the house that you bought. Then they bought other houses. And the more houses be built, the more they gonna sell for. So the more they sell for, let's say you bought your house for 100,000. The person next door to you, or two doors down from you, they bought their home for 115,000. Two doors down from them, two houses down from them, they buy their house for 150,000. That's the same square foot, same structure. Uh, let's say two houses down from them, their home sell for 165. So if this is within a 6 month time frame, okay, then guess what? You just accumulated approximately $65,000 of equity in your home. What is equity? Lois, would you like to help them?
Equity is basically um, how much your property has appreciated in value, meaning improved in value since you purchased it. So if you've purchased it, like she said, for $100,000, and because of the recent comparable sales in the area, they're now selling for 165. That means you have 65,000 in equity, and you can use that in a number of ways to leverage um, just your overall financial wellness. But it increases your net worth. So if you owe $100,000 and your property's now worth 165, then just with your home considered alone, you have a net worth of $65,000, and it can go upward from there.
Because guess what may have had to happen? You underestimated how much money you were going to end up spending before you moved in. Let's say you went and got a credit card and you maxed it out already. And then you decided you need to get a new car. Okay. So guess what? That $65,000 can pay off that debt and pay off that car. And guess what? If the interest rates are going down, then chances are your mortgage payment may, even though the mortgage loan is going up, as long as the interest rates are going down, it's possible that you could be making the same payment that you were at first when you bought the house for 100,000. That is how the numbers go. Interest rates determine the payment. So remember, we're walking into a time where the market value is up, the interest rates are going down. So if you're making a payment for, let's say, $1,400 or $1,200, okay, and you saw $70,000 worth of equity in your property, and you finance your home at a 7 or 8%, and the rates are going down 5 and 4, and then it's possible that you can refinance it, get cash out, and be around about in the same area you were paying at first. That is possible. Because remember, interest rates determine your payment. If they go down, the payments go down. If they go up, the payments go up. Any questions? So, in other words, equity, also known as cash. People say money don't grow on trees. Well, it does grow in your home. That's why it's called an investment. And there's no limit on refinance, on how many times you can refinance the house. If $100,000 of equity falls, just flow in your home, guess what? You can get it. But the only thing is, with the financing side, you only can get up to a certain percent. You cannot get the full 100%. You can get, it depends on what kind of loan, cash out, whatever the case may be, or if it's a primary or investment. Okay. Because on a cash out investment, let's say you got a rental property you want to get cash out of, you can only go up to 75%. Now, if it's your primary home, that means you live in it. This is where you live, this is where you stay. Then you can get up to some 90%, sometimes. It depends on your credit score. Did you want to add to that, Lois?
I think you covered it pretty good. The only thing I'll mention is I've heard people say that purchasing a home does not help you to become wealthy. Like you can't become wealthy owning a home. You never own it. You have to pay the taxes on it, blah, blah, blah. Now, I'm really not a shopper. I'm not sure we have a lot of shoppers on the phone. But when it comes to owning something that actually appreciates in value, that is one of the only things that we will own in a lifetime that will actually appreciate or improve in value. So we buy a lot of things, but to say that renting is better and you need to own and not and owning is not a good thing, it's kind of ridiculous. Now if you do other things with your money, if you're a savvy investor, whatever, you have a plan, great, as long as you're doing something where your money is going to work for you. But homeownership is pretty practical because you need somewhere to live. Everyone doesn't know about the stock market. So if you need somewhere to live, it's good to make a smart purchase and invest in yourself. That's my 2 cents.
Okay. Does anybody have any questions? Okay. So a refinance, okay, let me tell you about a refinance. One of the different thing in a refinance versus a purchase. It used to be a time where with the purchase, we always ask for verification of rent. Now we don't even ask, most lenders does not ask for a verification of rent. Okay. But when you're refinancing the home, they do want to know, how did you make your mortgage payment? If there are any lates in the last 24 months, then Lois, you want to answer that question?
Well, it can mainly be an issue, especially if you have to go into a manual underwrite because the the guidelines are a lot more strict. So it's a good thing to within the past 2 years have made your mortgage payment on time. There are times where, when looking at the automated underwriting um, decision, that there can be a late payment or so and it will still approve, but typically you have to have some assets in order to still get an approval and a decent debt to income ratio.
Hmm.
So it just really depends. I've seen it swing either way. It's just good to always make your mortgage payments on time. And if for some reason something comes up where you cannot, talk to your lender.
And that's one of the reasons. Remember, now if you have a loan officer that asks you, "Hey, can you give me this? Can you give me that? Can you give me this? Can you give me that?" That's because we're needing to satisfy the underwriter. Because the underwriter needs a full understanding. They need a full visual of your story. They don't need to be able to have to ask any questions, because if they do have any questions, they're gonna be what they call
Pretty sure if
conditions.
you got
Hold
a
on.
speaker, it's probably got a mic.
Okay, they're gonna they're gonna ask questions. They may say, "Give me a letter of explanation for this. Give me a letter of explanation for that." Da 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 da. You know, and it's gonna be frustrating to you, depend on how, because a lot of times you guys are a little anxious. And I'm gonna be honest with you, to put that kind of energy on a loan officer is not good. It's not healthy for the loan, because I'm gonna tell you something. When people rush, then we feel like you're trying to get us to look over something. So that's happens a lot in the industry, but that makes me push back so I can make sure I'm focused. Okay? Because at the end of the day, whatever the underwriter say is what's really going to go, because they're the person who's signing off on the deal. So I'm going to bring Petronia up. Hey Petronia, are
Me?
you at work?
No, I'm not at work.
Okay. How you doing? Oh, tell your husband I said hi.
Satonya say hi. She said hi. So my question I was trying to get through was about the refinancing.
Uh-huh.
I was trying to see, so example, if you have a loan and it's 100,000 and your interest rate would say 7% and you're paying on that, you refinance it 2 or 3 years later with a 3% interest rate. Do you are you clear of the 7% interest rate that was attached to that $100,000 loan, or are you
Yes,
paying? Okay, so
I
that
get it.
is erased.
Yes, you're paying that current mortgage off. Okay. When you refinance, you're paying the existing mortgage off.
Okay, so you are paying the
Because
interest twice then.
no, you're paying that mortgage off, so the 7% doesn't exist anymore. Because now here comes the 3%.
Right, but
So
if
the
the
mortgage
seven
payment
percent
goes down.
made so
Hmm?
if the 7% made the mortgage total say 150 with the 7%, which I know that's not gonna be exact,
Okay.
then that's already set. But when you're refinancing it, are you still refinancing it with that 150 with it, which included that 7%?
See,
Or
that's where the equity come in, right? Because this got to be a make sense loan. Okay. So watch this. Now this is gonna be why the appraisal has to come in effect, because that house is gonna need to appraise, right? To
hmm
make sense because it's gonna have to appraise for more than the payoff, right? Because
okay.
this is what you call a rate in term. So that means you're either getting a lower rate or reducing the term or extending the term, one of the two. So that's called a rate in term, where you refinancing the home to get a lower rate. As long as it's paying off, the appraisal comes in to where it can pay off the existing mortgage, then it's a beneficial loan.
I'm sorry. Are you asking about you believe that if you have a mortgage that was at 7% and you're paying the mortgage payment according to however it calculates at 7%, that
Right.
that balance is going up past 100,000, because it's not. It may be coming down slowly, but your balance isn't going to increase while you're making these payments.
Right. The balance won't increase, but
Right.
so okay, let me start over. So if the loan was 100,000 and I had a 7% interest rate,
Hmm.
and then when I refinanced at say 3% interest rate, does it
Hmm.
take the interest rate that was added in at 7 and does that wash out, or is that carried over in the 2% loan and is just reduced for the monthly payment?
Yeah. See, it's like you're thinking about compound interest, so it doesn't apply. The 7% would no longer apply. So if you started with 100,000, depending on how long you had that mortgage, your mortgage is now lower. So let's say you pay on it for some years, you're at 90,000 now. Then whatever that mortgage company was is going, that loan is going to be paid off, that 90,000. Then you take that 90,000 over to another company at 3%. So
Okay, okay.
you're not paying twice, because you've actually, um, your circumstances are better now, because unless you increase the balance, like you get some cash out, you refinance your car through there, or pay off your car through there, or pay off credit cards, your balance is going to be lower. Plus, your interest rate is going to be lower. So your payment will be lower than it was at 100,000 at 7%.
Okay. That's what I was trying to see. I know it would lower your payment and it would wash
Mm-hmm.
out the past loan, but I just didn't
Mm-hmm.
know if the amount that was at that 7% would be carried over. But from what
No,
I
it's not
understand
going to
now is it
roll.
will not be carried over.
That's how student loans are. You roll all of that
Okay.
interest along with it. That's not what a mortgage is.
Okay.
You're starting
That's what I was trying to
fresh
see.
at a lower balance and a lower rate. Hmm.
And I'm
Okay.
so glad you brought up student loans because I wanted to elaborate on that. Student loans, there's a reason why we ask you guys to go ahead and get an income-based repayment letter. And the reason why is because in order for you to qualify for an amount that you desire, then we could utilize the income-based repayment amount that's in that letter. Okay. Let's say that you owe $150,000 worth of student loans. That is your total balance. Or let's just use an easy number and say $100,000. Okay. So if you don't provide the income-based repayment letter on an FHA loan, then what happens is we have to utilize a 0.5% of your balance for your payment, and that will equal to $500. So even though you don't make a payment every month of $500, we have to utilize that because over the course of 30 years, moving forward, you are still going to have to pay on those student loans, although we don't know what the payment is going to be, right? So the income-based repayment letter will be one of the first things that you will need to go ahead and call because it can take anything between 2 weeks and 60 days to receive that letter from the student loan company. Let's talk about the IRS. Okay. Now, if you owe for the current year, let's say we're walking into 2023. 2023 is not due until April the 15th. So we don't we're not going to ask you if you filed your taxes or not, da 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 da. But if you owe for 2022, currently at this time, is this correct, Lois? You're still going to have to pay 2022 taxes at closing for the current year because it's not April the 15th yet.
Correct. Or if you have a payment arrangement,
Mm-hmm.
IRS agreement, installment agreement, then we need you to have made three on-time payments, and we need the official agreement, a copy of it.
Okay.
Hmm.
So the payment arrangement now, if by chance for 2021, let's say you owe 2020, 2021. Then if you owe the IRS, then go ahead and put together a payment plan, a payment agreement uh, in an installment letter is something that you're going to need to present along with at least three on time payments. Okay. You have to have uh, an agreement with them. You can't just pay them what you want to give them. It has to be an agreement letter, a payment plan in existence. Okay. It has to be with three payments. Now, on conventional, Lois, is it 3 to 6 months?
No, you may find some overlays that way.
Okay. Okay. So you have to have the payment agreement with the IRS and three consistent payments, on time payments. Okay. Now let's talk when it comes down to income. Okay. You could utilize money from your job because we're in the tax season. I want to go over this. If you're utilizing fast cash when you file your taxes, that is a loan. You cannot utilize government money as a down payment on a mortgage, and you can't use student loan money as a down payment. You can't use the fast cash. I don't know if you know this, but fast cash, that cash advance money for when you do your file your taxes, that is a loan. It comes with an interest rate. Okay. Um, but you can use your tax refund. You can use your 401k, and you can use your savings or checking. It just cannot be any form of government money. You can use child support if you have 12 consecutive payments that he paid on time or she paid on time, along with a child support order. The child must be under 15. You can use Social Security for a child or for yourself. You can utilize that as long as the child is under 15. You provide the child's birth certificate and the awards letter. Okay. Now, those are the additional income that you can use to qualify. Now, also, as far as the student loan, it's very important to get the income based repayment letter. It cannot say zero. It can say $5, it can say $2, it can say $8, it can say $35. As long as it has an amount in that letter, it cannot say zero. If it does say zero, then we got to go back to the, for example, if the balance is 100,000, we got to utilize a $500 payment, which can make you qualify for less. Now, if you have a student income-based repayment letter that says $35, then that's eating up 400 and some dollars. You can utilize that space to be able to qualify for more. Lois, did you want to add to that?
No, you were pretty thorough. The only thing I'll add to it is something we've been seeing is those who are on that, I don't know what they call it, some kind of new start or healthy start program or something like that with student loans if they have been in default at some point. Some of those are coming through where and how it shows up on your credit, it shows that those balances are zero for the defaulted loans and the new ones have to report and they're taking a while to do that. So that can
Mm,
be a delay. And the
mm,
only way to get it to speed things up is if you have something official from them saying that you are a part of that program or what the payments are.
okay.
Fresh start, that's what they call it.
Okay. Okay. So did you guys have a question about the student loan? Okay. Because remember, it's tax season. Be careful how you get the cash if you want to utilize it as a down payment or toward closing costs, because you cannot use government money as a form of down payment on a home. You can't use hardship money as a form of down payment on a home. You can use gift money. It can be, Lois, you're gonna trip out when I say this. It could be baby daddy, baby mama. It could be mom, father. It could be brother, sister, godparent, godmother, godfather, grandmother, grandfather. It cannot be a cousin. These
Well, they can be a close friend. You
it
have to,
can now.
yep,
Okay.
close friend, close family connection, and then each has to write a letter to state what the connection is.
Okay.
Mhm.
And the reason why is because they know that the underwriter know that you got to pay these people the money back. So an immediate family member, they just want to help you because they're happy for you. Taking this step toward home ownership, they just want to help you get it. They don't care about if you pay them back or not. They just happy for you to be able to get in the house. The only thing is you will need to provide a bank statement from them that they had the money to give you. Now, you might have to fight them on that because they might not want to give you their 30-day bank statement. But they cannot have taken a loan to give you the money because we know that you're going to be having to pay them that loan. It's just going to be a debt for you to pay them back every month. Any questions? So I didn't expect to take this much of Lois' time. I wanted to take the time out and say thank you because she's always there when I need
Question.
her. And she's feel I'm I just want to say thank you, Lois, because you do come through and it's a weeknight. And I think she left, but I don't know if she got her phone messed up or whatever. But I did want to take the time to say thank you and thank you guys for coming in, and we're here for you. We want to be able to help you get there. Uh, and we're happy for you to take the first step. The first step is taking the time out to learn and understand the process to make it a smoother process for you. And so I didn't want to take up much of your time. Tonight is a school night. Our kids here have been out of school for 1 week and 1 day due to the weather. So they're going to school tomorrow. And unless I go online and find out something different. Okay. Uh, Lois said her phone died. And I just want to take the time out to say thank you. Y'all tell her thank you in the chat. I'm finna tell her thank you. Thank you, Lois. And then it's 10 o'clock her time too, you know. And so, it's time for, I didn't want to take up too much of her phone, her time. But thank you guys for tuning in. You guys have any questions, you have my information. I sent you my email address. Um, thank you, thank you. Uh, and I just wanted to say thank you guys for tuning in. Thank you guys. If you had any questions and you answered them, we answered some of your questions. Understanding is the best thing to have. Okay. This process is not hard at all. It's just that it's a documentation thing. When it come down to um, buying a house, remember it's the credit report that gets you pre-approved. It's the documentation that gets you closed. And you just gotta stay within that line. The underwriter, Lois know I thank you. You're welcome. Lois know I call them the police. Okay. The underwriter is the police because they can stop the show. You know, it takes them to sign off on everything. They're the person that determines if the file is gonna close. Um, so they are the key to the file. And the underwriter is the person, the loan officer is the person who takes the vision and makes it plain. And that's the underwriter has to understand what the loan officer just presented to him. That's why I always ask you guys for all the documentation up front because I have to structure the file to where she has to understand it. But remember, it goes to two other hands before it get to the underwriter. So you got to really structure that file to where, when it get past those other two hands, then she get it. She got the story. Every credit report and every credit loan or loan application has a what they call a credit profile. She has to understand your story. And there's a story with every file. It's a different story. And nobody has the same story. Everybody can have somewhat of the same score, but nobody has the same story. So what we do is we read the story and we present the story, and she sign off on the story, and then that's what the story ends. So I'm not gonna hold you guys. Um, Thank you again for tuning in. I know it's getting late. It's a work night. The kids got to go to school, stuff like that. And feel free to tune in. I'm gonna come back next week, and we're gonna have another guest. And feel free to share the live. Have them subscribe to the channel so that they will receive the notification when we come back. I like to do this more, and bring more people that's involved with the loan, the people that's behind the scene, so you can kind of get an idea and know it's other programs out there, not just the standard programs. There's they're financing for people that want to buy a home with their LLC. It's things like that. It's certain credit scores that can get you certain places. I want to be able to bring those people on to share those type of programs with you, and I am. So feel free to tell people about the channel, subscribe to the channel so you can get the notifications, and we can be able to, help the community grow, right? So I'm not going to hold you guys very long. Again, thank you for tuning in. Miss Gina, did you have any more questions? Did anybody want to come up and ask any questions?
I think the only other question I had was about the refinancing. If you was to refinance, would you have to pay another like closing costs for it?
Yes, because in it, that's a whole nother process. Because you got to buy the house, you got to own the house to refinance the house, right? So it's already a loan packaged up with the first mortgage, right? Regardless of whoever done it. So you're starting all over. That's what it's
Okay.
called that's where the RE and financing coming in it, refinancing. Yeah. Because it's a whole nother loan, it's a whole nother process. Hmm. But did you guys, before we go, did you guys have any questions, or did you guys want to come up and ask anything for before we close out? That link is pinned in the chat. Let me see. That link right there is pinned in the chat if you guys had wanted to come up and ask any questions. Okay. If you don't have any questions, we are going to say farewell. Good night. And I don't have a schedule right now, but I don't know when we're coming back on. But I am gonna bring you guys some more people to talk to you guys so that you can get more. You're not gonna get it in one night, okay? I didn't learn the mortgage business in 30 days, 60 days, 90 days. It's a never stop learning process. You know why? Because programs change, credit scores change, everything changed. Okay. So remember, if you feel free to email me, I'm putting my email in the chat. Okay. And send me your phone number and tell me your scenario. I give you a call. I email you back, and we can talk. Okay. So feel free to reach out to me. You can reach out to me on Instagram, Satonya Ford, Facebook, Satonya Ford, and let me give you my email me, and I'll give you my information. Okay. So with that being said, I'm gonna say good night. We're gonna turn it in, say our prayers, and go to bed. Okay, you guys, I really enjoyed you guys, and thank you guys for coming on. Good night.